Hi everyone, welcome to this month's Financial Markets Update. Well, December proved to be another difficult month for financial markets. We saw equities, bonds and property all lower over the course of the month and really reflected a microcosm of what we've seen throughout the course of the 2022 calendar year. And now we've just got a chart probably just highlighting a few elements of the performance of markets over the course of the year. And this first chart here just shows the absolute performance that we saw across all the major indices, and you can see really outside the local Australian equity market that was only down roughly around about 2%. All other major indices were significantly lower over the course of 2022, and particularly those that obviously were interest rate sensitive, such as bond markets, as well as obviously REIT markets. They were impacted by obviously higher cash rates and rising bond yields throughout the course of 2022. However, when thinking about that in the context of the entire year, we did start to see some recalibration of that performance through the second half. So, it really was a tale of two halves to some extent. You can see here in this chart that even though performance was negative for the entire year, throughout the second half, we did start to see some recovery in equity markets, namely developed market, large cap and small cap equities, and there's some moderation in the level of underperformance in other parts of financial market systems. So EM did have some recovery through the back end of the calendar year, and obviously the declines that we saw in both REITs and government bond markets was lower through the second half of the year relative to what we saw through the first half of the year. And from our perspective, this was probably to be expected given the fact that a lot of the cash rate moves that we'd seen by central banks, a lot of that occurred throughout the first half of the calendar year. And certainly as markets were looking forward, they were seeing that central banks weren't going to be as aggressive in raising cash rates as what they were through the first part of 2022. So that moderation in underperformance from our perspective is a positive when we think about into 2023, how we position portfolios and the likely outcome in terms of asset class performance over the course of 2023 and beyond. When we think about the overall performance of financial markets, there are really sort of four key factors from our perspective that drove that level of underperformance. And the first of those was that inflation proved to be far more sticky and less transient than either central banks or governments felt it would be coming out of COVID, and that did result obviously in significant and aggressive moves by central banks right around the world to increase cash rates in order to try and dampen those inflationary expectations. From our perspective, we sit here today, we continue to expect that central banks are going to continue to push rates higher, but we're not expecting that it to be the same level of what we saw through 2022. And again, one of the reasons why we did see some level of moderation in the underperformance of those interest rate sensitive sectors through the second half of this year. But to highlight the challenges facing many central banks as well as governments around the world, Australia's December CPI print came in for the quarter at 1.9%, so that was up from 1.7% in the September quarter, and that brings our year-on-year CPI inflation number to just under 8.5% at 8.4%. So there's still a long way to go if central banks are likely to push to that 2 to 3% target band, and we think that's probably going to be a real challenge over the next couple of years for central banks to be able to achieve that without causing a significant decline in economic activity. And we think that's going to be the balance that both governments and central banks are going to be facing throughout 2023. The slowdown in economic activity in China had a big negative impact, not only in terms of global growth, but particularly around emerging markets. And that's one of the key reasons why we saw a significant sell-off in emerging markets throughout the first half of the year. And one of the reasons why emerging markets have been, certainly recovered quite strongly, certainly through the fourth quarter of 2022. And that level of underperformance was moderated somewhat on the back of that. So the pivot by the Chinese government around the growth outlook, certainly through the back end of the year, shift away from having COVID zero policies, the shift away from rolling citywide lockdowns, we think is going to be a positive for Chinese economic activity in 2023, and we think that will ultimately flow through in terms of global economic activity, and particularly as it relates to the performance of emerging markets that we feel certainly from a valuation standpoint are attractive, but certainly some of those headwinds, as I said, particularly as it related to China, we think were a negative through 2022. We think some of those negative aspects are going to be shifted to one side, and we think there should be some positive impetus for emerging market equities as well as debt, throughout the course of 2023. Clearly, geopolitical risks were a big negative for financial markets in 2022. Russia's invasion of Ukraine and the associated impact that had around commodity prices, the growth outlook for Western Europe, energy supplies more broadly, all of those challenges in our view are going to continue to be at the forefront in 2023, along with obviously tensions in trade between the US and China. We don't expect that that's going to moderate throughout 2023, and we think that heading into an election year in the US in 2024 is likely to continue to be a big impost in terms of getting geopolitical risks off the table and allowing investors to focus on valuations and those types of things. So we think geopolitical elements are going to be another big driver in terms of financial market performance throughout 2023. And then finally, the US dollar. Strength of the US dollar was, again, a big impost in terms of financial markets in 2022. And we think that, as we head into 2023, we've started to see, that moderation in the US dollar. That's on the back of, obviously, inflationary expectations starting to come down a little in the US. And that, again, will play into the US Fed being less aggressive than what it was in 2023. We still expect the Fed to push cash rates higher, but we think it'll be at a more moderate and a slower pace than what it was in 2022. And so we've started to see, as I said, that shift in the US dollar, and that has provided some impetus to certainly emerging markets over the last couple of months. Certainly those economies that have debt denominated in US dollars, we think that does provide some flexibility on the fiscal side for those countries. So the moderation in the US dollar, we think, will continue throughout the course of 2023, and as I said, that will provide, as I said, some uptick in financial markets. So overall, when we think about the performance of 2022, we look at obviously what we're seeing in regards to those key drivers. We think a number of them are going to clearly be very important as we head into 2023. But we do think that we are starting to see some moderation in the negatives, and we think that will ultimately play out as we head into the second half of 23 particularly, and will afford some opportunity for investment markets to recalibrate and, as I said, move higher over the course of 2023. And then finally, just how do we sort of package that in the context of our portfolio? So just got an outlook slide here that reflects our capital market forecasts for 2023. And you can see here that certainly those asset classes that had a significant negative, particularly looking at both emerging markets on the equity side of things. Even if we look at certainly in the context of some of the real asset exposures, we believe that certainly those parts of the market can continue to move higher, and as I said, are primed for some level of recovery. And those markets that have done well, commodities particularly, we expect them to continue to move higher throughout the course of 2023 as the demand cycle also remains elevated. But by and large, we are starting to see, as I said, a more positive outlook and a more positive backdrop once we start to see, as I said, that peak rate cycle get through the system, once we start to see a more notable element around inflation expectations start to moderate. What does that mean from a recessionary outlook? We've heard a lot about that over the back end of last year. Certainly our view is that we expect economic activity to remain constrained through the first half of this year. Recessionary outlook in terms of the unemployment is probably the thing that we're most focused on. Unemployment continues to remain at multi-decade lows, both here in Australia as well as around the world. And we think that unemployment can remain at sub 4.5% here domestically. We think that Australia will be, along with the rest of the world, will avoid a material recessionary environment. And as I said, from our perspective, that's the main thing that we're focused on, particularly when you're talking about higher cash rates through the system. So for us, that's the big issue. At the moment, unemployment is very low at 3.5% here. Domestically, as I said, roughly around about 3 to 4% globally. We think if that can be maintained, that will result in, an economic slowdown on the back of higher cash rates, but we won't see a significant recessionary environment. And we think that ultimately that will be good for financial markets once we start to see inflationary pressures moderate further through the second half of 2023. So, as I said, a really challenging end to calendar year 2022. As I said, a lot of the factors that have been driving that, we believe, will start to moderate in 2023, and we think as we head into certainly the second half, there will be some opportunity for investors, as I said, to reposition portfolios and take advantage of some of those market environments that, as I said, were more challenged through 2022. As always, if you have any queries about your portfolios, please feel free to reach out to anyone in the team, and look forward to catching up again next month. Thanks and bye for now.